It's just a Word document system. Can you make, like, just put the first one up, and I don't know how big they could see it and stuff. This way, it's just one page at a time. That's good. Okay, where should I see?
You can see anywhere, the camera's right behind you, so if you wanted to either sit in the middle or stand in the middle, or whatever you want to do, feel free. So everyone on Zoom can see you, everyone out here, on your call.
Okay, very good. So should I face them or them?
Oh, doesn't matter.
I'll try to face them. Okay, my name is Augustino Javier. Mark with his dad. He asked me to come today to do a little session here. So this is 5 popular deductions for real estate agents. Just a quick background. I've been doing this for about 35 years. And every time I say it, I get scary because I get a little older every time I do this. I am currently a CFO for a manufacturing company in Paramus, but I also have a little side business that I do some tax work for about 100 individual clients, some corporate returns, some partnership returns. Keeps me busy during tax season and a little bit during the rest of the year. So this says popular, but this is just the top 5 that I picked. There are hundreds of deductions there, and popular communities to anybody. Can you bring up the next one, please? So meals and entertainment. It's one of my favorite, as you can see. And it's the reason why I put this one up first. It's nice because for 2021 and 2022, and those of you that have been in the business here probably know most of these deductions. But for 2021 and 2022, because of COVID and the incentives to have people go out to restaurants and stuff, because those businesses were really hurting, they made this general rule here for just these 2 years that you can deduct 100% of business-related food and beverages purchased from a restaurant. After 2022, the limit goes back to 50%, which is what it was. So the IRS actually has a definition of a restaurant. It's a place that you can get food, because the idea is for them to go to the people that are suffering, the true restaurants, because nobody was going out. So that's a business that prepares and sells food or beverages to real estate customers for immediate consumption. So it's regardless whether it's consumed on the premises or not. It's not a place where, like, if you go to a grocery store or something like that, that has prepared food. That's not really the intent of this. This is the true restaurant that you go out to get food, to keep those businesses open, because they were the ones that were really hurting. But after 2022, it goes back to the 50%. Next one. So as I said before, so the grocery stores, they do not really count, even though they do have food. It's mostly for the sit-down restaurants and stuff like that, catering, and those kind of things. So no deduction for entertainment, like at sporting events, theaters, etc. There used to be, back in the day, as they say, there used to be deductions if you took somebody to a sporting event, or even on a boat and stuff like that. Not anymore. Any kind of entertainment is out. All that, zero, no deduction left for that. Now, meals and non-deductible events must be stated separately to be deductible. So in other words, you go to a sporting event and you pay $100 a ticket, that includes the food and the sporting event. It's not deductible unless it says, you know, the event is $75, and the meal is $25. Otherwise, you cannot deduct the meal. It has to be stated separately. Okay, and there's no deduction for lavish and extravagant meals. Now, I'll add to that. So, of course, the situation that you're in and where you're going is going to dictate whether it's lavish or extravagant. Okay, so if you're in a rural area and they have, you know, your local restaurants that's a regular place, and that's fine. If you're in Beverly Hills and you have that type of a client, and you're gonna go to a restaurant where it's gonna cost $150 a person just to sit down, that's really not considered exclusive or extravagant, because it's for the client, or the, it has to be for the situation that you're in. Okay. Office supplies, I guess my formatting didn't work out when I finalized this. So office supplies and capital expenditures, that's the next topic there. So supplies that are used in the trade or business, and items that you use up in 1 year. So that's everything from paper clips, postage stamps, paper, any consumables, let's say. So under a year, these items get expensed in the year that you buy them. Even if you buy them in December, of course, you're not going to use 3,000 paper clips or stamps in December, but they're expensed. Maybe, possibly. Well, that means it's good business, right? So if you, regardless of when you buy them in that calendar year, because everybody's a calendar year taxpayer for the most part, you're going to deduct them in the year of purchase, regardless of when you buy them. You don't have to consume them. You just have to purchase them. Then we get to capital expenditures. So capital expenditures is more of a hardier type of purchase, right? It's a purchase that's used in traded business, and there are things that you can pretty much use or use for more than a year. They include things like computers, printers, furniture, more big tangible stuff. These items will get depreciated or amortized over the useful life of the assets, with few exceptions. So if you have software that you buy, that'll get amortized. Other stuff will get depreciated over the life of the asset. Now, when I say a few exceptions, there are things that you can depreciate. They call it Section 179 depreciation, which you can take the full cost of the asset and expense it in your first year. And you have to have income to substantiate that. You can't deduct, $100,000 item if you only made $20,000 for the year and stuff like that. But you can take the full depreciation for a lot of capital items as well. Okay. Automobile expenses. So this is a great topic because there's two different ways that you can deduct automobile expenses. And this is one of the most used, I believe, by most businesses, especially real estate agents, that you're driving out to homes, customers, clients, we call them, right? So there's two different ways to take these expenses. One is for the actual car expenses, the actual costs that you incur, or the IRS standard mileage rate. So the actual car expenses are, you take depreciation, registration costs for the car, insurance, gas, repairs, pretty much everything that costs to run that car and maintain the car. You buy a seat cover, if it's all used for business, you can take it. Depreciation, they have different rules for depreciation, luxury automobiles, as they call it, as opposed to other items such as computers and furniture and stuff like that. They actually have a limit system that you can depreciate each year for luxury automobiles. And like I said, anything associated with the expense of that car is you buy an air freshener. Then the next one is the standard IRS mileage rate. So this is another good one, and I don't know if you guys have seen this recently. So for 2022, the mileage rate was 58.5 cents per mile, and not too long ago, just recently, they changed that. Gas is going up, right? Sadly enough, so they changed that from July 1st to December 31st. They increased it by 4 cents to 62.5 cents a mile, right? Everybody's excited, I can see. So, keep your receipts. You're supposed to log all the mileage that you drive. So you can choose one or the other, right? Actual car expenses or the IRS standard mileage. Once you have a car, you put that car in service, you pick one. Once you pick one, you can't change. So if you have a car and you started to depreciate it and you use that, you cannot change to the standard mileage rate until you get rid of that car, and then it starts all over. Okay, that's so you don't flip flop back and forth. Do a little, back in the paper calculation as to how much you think you're going to drive, the value of your car for depreciation, because that's usually the biggest expense. Well, now maybe gas maybe close up there, and then see whether the 58.5 cents a mile or 62, whatever, is more beneficial than the actual car expense. You have an older car that's worth $2,000. That's the cost that you're going to value of the car when you put it in service. That's what you're going to depreciate. If you have a $40,000 car, then maybe the actual car expense may be the best, but you have to be able to show that you're using it, 100% for business, or mostly for business, to get that depreciation. So keep track of the mileage, know this stuff. If you have a second car at home, that's always best to show that this is exclusively for business. But record keeping is important for your mileage and stuff. But you can always deduct parking fees and tolls, whichever method that you do pick. So it's not out of pocket that you have to worry about that. But gas and repairs and all the other expenses are all included in the IRS standard mileage rate. You get nothing extra. Okay. Next, please. So this is just the form, the IRS form about your vehicle. It shows that when you place the service, the number of miles that you use for business, commuting, other, then several questions if excuse me, if it's available for off duty, if you have another vehicle for personal use. So they try to make sure you answer those questions correctly, because you may disqualify using taking the depreciation. Okay, home office deduction. So this is another nice one here, and the IRS says that it has to be exclusively used for business, right? Exclusively and regularly used as a principal place of business for trade or business. So you can't just have an office. You have a little desk and then a computer, and you spend most of your time here. You do no work in it. Do people do it? Can't say. But you're really supposed to use it as an office for its intended purpose, and it's supposed to be exclusively. They added that not too long ago. It's exclusively and regularly, because some people will have a desk for their wife to do the bills on, filing cabinet with all their personal stuff, and they have all their personal stuff in there, or maybe a little couch for somebody to watch TV. Okay, right now it's not your exclusive and regularly place of business, so you have to be careful. So when you do that, there's two methods that you can use here as well. This is another neat little thing. So the simplified method is not that old. It's a couple of years old there, where you could get a standard $5 per square foot for the portion of the home that's used for business purposes. Cannot exceed 300 square feet. If you have a 2,000 square foot house, you can't say, well, half of my house I use for business. Now, a reasonable space, 300 square feet is a reasonable space for an office. So that gives you, if you do have 300 feet, the maximum deduction is $1,500. You don't have to do much. You have no bills, nothing like that. All you have to show is that it's used exclusively and regularly for business. That's it. That's the simplified method. So the actual method, of course, what we call actual, everything that's real, everything that's the cost of your home, which is allocated based on the same formula above. The square feet that's used exclusively and primarily for a place of business. So you actually get depreciation, utilities, insurance. All that is just based on the prorated portion of what you use for your home. The home is over, I believe it's 27 and a half years. I forget, I'm getting a little old, but I think it's over 27 and a half years. But And you cannot include cost of the land, so it's strictly the cost of the house. So when you actually gonna do it, and you have a house worth 250,000, you need to get the land value and separate that. Of course, most of you will have people doing the tax returns, and they'll take care of that. But some people say, "Oh, I have a house that's worth so much money," but you have to look at what the land value is wherever you're located. And if it's worth half the house, you only get half of the deduction that you really pay. So it's important to know that. And then everything else, utilities, if you have repairs that are directly related to that room, get 100% depreciation, 100% deduction. If you paint it, put a rug, fix the doors, put new windows in that area, it's all 100% deductible for the actual expenses. Excuse me. If you do repairs to the home, you put in a new roof, new air conditioning unit, things like that are for the whole house, that gets same allocation as the house does, the same square foot allocation. So you really do get a neat benefit if you meet the qualifications to be able to take that deduction. So that's pretty good. Any questions? Is anyone?
There actually was a question in the chat box,
Sure.
and it asks, what's considered commuting versus showing properties?
Okay, so commuting is, I'll do it backwards. Show property is when you go from one place of business to the other, it's deductible. So if you have a home office, your home office will be considered your place of business, and if you go show a piece of property of that commuting, that travel. I don't want to use the word commuting because commuting has a certain definition. So that travel from business to business and business to pick up, even if you pick up a client to go to the house or whatever, anything in between is 100% deductible according to whichever you're using, whether it's the car allowance or the standard miles standard. That's all deductible. Commuting is when you just go from your home, which does not have a place of business. You don't have an office in your home. A true, again, you have to clarify, a true office in your home. If you spend most of your time in an office here or someplace other than your home, to get from there to your first place of business is not considered business. It's commuting. Okay, anything after that, when you get to your first place of business forward, is always deductible. So if you don't have a home office, okay, if you don't have a home office and you're close to your regular office, your business office, there first, and then everything from there is deductible. So if you're 3 miles away from this office here, and you don't have an office at home, come here first, say hello, and then drive out, because everything from this point forward counts. The first 3 miles, 3 minutes, whatever, it doesn't count. Okay, hope that answers that question. Okay, health insurance. So health insurance is
There actually is a one.
another.
Oh, no, she just said thank you.
You're welcome. So the health insurance write-off, look, this goes, maybe a few changes, goes on page 1 of Form 1040. It doesn't go directly against your income, your Social Security, your Schedule C income, because your net income from Schedule C is subject to full Social Security and Medicare with certain adjustments, but it's the full Social Security and Medicare. There is no employer part of Social Security and Medicare. Even though this is a deduction, it does not reduce your Social Security and Medicare expenses and liability on your tax return, but it does go against your adjusted gross income. But it is a really neat deduction, because years and years and years ago, you used to, the only way to get medical or health insurance write-off was to be able to itemize. And now the IRS increased the standard deduction to over $12,000 for a single person, over $24,000 for a married couple, $25,000. I've seen almost half of my clients not be able to itemize when the 2018 regulations came out, the new standard deductions. So people who aren't able to itemize at all, Even with the medical, you had to go over 7.5% or even 10%, depending on what your age was. Few people were actually able to use the health insurance deduction. So this is really good that it goes on page 1. It cannot exceed the income from self-employment. So if you make $2,000 in your Schedule C, your earnings, right? Your net of tax, net of expenses, and you have $10,000 in medical expenses, you can only deduct 2,000. You can't deduct the whole thing. This includes medical, dental, and vision. It's all health insurance, okay? Not just medical. Some people think it's just medical. And the other neat thing is, I mean, most people are, well, everybody's young here, but as you get older, Medicare, when you collect Social Security and then you pay for Medicare, your Medicare expenses, those payments can be deducted under this medical insurance deduction. So that's another neat thing to know. Let's.
I have a question. When it comes in my husband's medical insurance.
It's fair.
Yeah, because I'm in.
Yeah.
Can I have that? Because he got this insurance from his work, so it's gonna. Can I do that?
Yeah.
Okay.
So this is just what's Schedule C, the expenses portion look like. I only went over 5 expenses, but there's a ton more on here. If you have insurance for your business that's on here, any legal advice or any kind of legal or professional expenses that you incur can be deducted on here. If you pay a preparer to do your tax return, excuse me, the portion to do the Schedule C, not your whole tax return, right? But the portion to figure out and calculate your Schedule C can be deducted on here. If you have a regular office outside of your home, then you're not prorating the square footage, deduct your utilities, rent if you have another office, true other expenses. So this is just a list that I put up there. And then I also included some publications here. The tax guide for small businesses will pretty much list most of those deductions that are on that form there. Business expenses just elaborates a little bit more. Same thing on there. Travel, gift, and car expenses will go over the two ways that you can take deductions for the car expenses. I added a couple more down here. Businesses use of your home, how to allocate what you can deduct, what you can't deduct, and medical and dental expenses, which will go over which you can deduct for self-employment. I should have put on there, I think it's page 22, but when you look at the front of the form, it'll say medical expenses for self-employed individuals. And that'll bring you right to the form there. So remember to document your income and expenses and keep all your receipts. The IRS says that if you have $100 of expenses and you show 0 receipts, guess what your deductions are? 0, right? Now, you can try to reason with the IRS, and sometimes they'll work with you, but sometimes they won't. So in cases where you can get receipts when you get them, keep them always, keep good records. The last thing you want is the IRS to come and give you an audit, knock on your door. They won't call you, but they'll send you a nice letter that they want to visit you. Okay.
They want you to come visit.
Someone just asked if it was possible to have this document emailed to them.
Yes, I put in a disclaimer at the bottom that this is not. Say it made it small so you can't see it. But, it's just for informational purposes only. This I put together, pretty quick, and it's not intended to provide, not to be relied on for tax advice. But all those links there are great links. The publications are 20, 30 plus pages themselves. You're not expected to read all of them, of course, but if you just go to the subjects that, everybody has different needs, depending on how long you've been doing this. your understanding of the income and expenses and stuff like that. But rather than searching, those are real. Make sure, one thing, a couple of things I learned is, when you Google, you could Google all this stuff, right? Everybody knows that you can Google it. The only thing I would say is, when you Google it, make sure that it's current. Okay, because for instance, the mileage, right? Make sure if you Google the mileage, you put it in the year 2022. In this case, it changed from the beginning of the year to the end of the year. Also, for the first one, the meals and entertainment, right? If you read an article from 2017, it's going to tell you 50% deductible. And back in 2017, that was absolutely correct. So the rules change. Most of these rules do not change that much, but every once in a while, mileage will change every year. Every calendar year, they have new mileage. They actually, I do remember them actually reducing the mileage at one point. When gas was it 4 or close to 5, and it went down to 2 something, or in the 3s. They did reduce the gas mileage, so you need to be aware of that. And also anything new that comes up. So some of these have been there for a while, but some are newer. So if you look in, when you read the Google, just make sure that you see 2022 or something within the current year. Okay, and the publications will always be up to date. Okay, any other question?
If you have a home office and you take that deduction, and you come to the office and you have a private office, that's deductible.
That's fine. Yeah. If you show that you use it, okay, exclusively and regularly. They don't say primarily, right? So exclusively and regularly. Exclusively is where most people have the problem. Because what happens? Things tend to wander in the office, just naturally, right? And you have to be careful. So take a picture of the office when you first set it up, and it's exclusive. and then you have to make sure it's still exclusive when the IRS agent comes to
Decides to want to look at it.
But most people don't have that big of a deduction. But self-employed individuals, especially those who make more money, are getting subject to more audits. So the more money you make, the more exposure you have, and the better your record keeping needs to be. I'll just throw that out there. Okay, good. Any other questions?
So I have like a question / remark. So you say keep all your receipts. I have a horrible issue of doing that. So what you recommended to me doing is either make one of your current credit cards that you have primarily for business stuff, or get a new one, not necessarily like an Inc. Capital One business card, but get one specifically and only use it for things that you do for your business, like you said, pens, pencils. I do my office supplies with it. I'll sometimes you just use it for like random things that I do for the office. Is that a good thing to do also?
Absolutely. I always recommend setting up a separate bank account. So all your deposits go in there, and a separate credit card will always help. This way you only have to look at one place. You don't have to go through monthly statements for your deposits. It's always good to keep a separate record of your income, especially if you have income from several sources, right? So your deposits will be all in one place, all your income. You look at your bank statement, you deposited $20,000 all year, that's your income. You don't have to go searching for it. It's pretty simple. And if you can show your IRS that, they tend to look less into your regular deposit, your regular bank statements, because that's the other thing too. If you're commingling it with your personal bank statements or other bank statements, well, hopefully you're pretty clean, because then what happens? Now you're giving them personal information, because they have to look at it if they want to look at your income and your deposits. Now, they may have other questions, but if you have one account, this is all my deposits, and you can show that that's where it is. They're not going to look at your other personal stuff. The same thing with credit card purchases, right? If everything's on one card and it's all business, and you can show that your other credit cards are all personal, they don't have to go through your personal credit cards and start questioning other charges. If you don't have a charge on there if you have a charge on there that's not business, can they technically question it? You know what, if they look at it, anything's subject to, you know, to question. So that is a good idea, that's the best way to do it. For meals, you have to have certain things in it, people that were present, business purpose. Of course, the receipt will have, you know, twice the time and all that stuff, but in your cases, business purposes is mostly, you know, the same thing. You know, you're talking to a client about potential acquisition, or if after you buy, you know, celebrating an acquisition or sale or whatever, you know, so you don't have to have a lot of things that you put on there. You can put the same thing, and that's fine, but you do have to have a business purpose. Okay, and the people that were present.
One question here says, would the bank be suggested once you have a business, or should you open it prior to starting?
Would the bank be suggested? Once you have the business, or should you open it prior to start? You can open it at any time. You know, it's fine, because whenever you open it, you'll have a year where you may have both, you know, your personal and the new account that you open, but after that year, you're a transition to the new account. So it's fine. You're not if you could do it beforehand, it's always great in anticipation. It's always good to have another account right from the start. But if you don't expect that much, especially in the first year, right? You start in November or December, and you're not expecting to have that much, you know, you can wait till the end of the year and just start fresh from there. That's not a problem at all. Okay.
Can you deduct like a gift? Because I know I've heard a lot of agents say like when they do stuff, they have like just like normal like Starbucks gift cards, and they have them by the stack. They just give them out to their clients. If you're gonna buy a bunch of those to give out to your clients, like after a deal is done, are those tax deductible?
You know, that is a good question, and I hate to say this because I should know this, but I know they've changed the rules with the sporting events and those kind of things. There's a de minimis clause out there and stuff. So I think $5 cards would be okay. I refer you to the gifts and stuff there. You can't buy somebody a $100 gift certificate and throw that out. But if you get $5-10 cards, those should be fine. I forget what the
Was the real estate commission the limit on what you give them?
yeah, because I remember years ago, even the many brokers and stuff used to give out gift cards and all this stuff. Take people out to sporting events. They killed all that. They killed all that. Okay, people take people out on a boat, right? You can take them out. It's just not that.
I've been asking you about that for months.
So you can do anything you want, but it's a question as to whether it's deductible or not. Okay. Good. Thank you for having me. Thank you, the audience out there. All right, thanks again.
Thank you.
Like, I wanted to-